This is the Investor Connect podcast program. This is Hall T. Martin. I'm the host of the show, in which we interview angel investors, venture capital, private equity, family offices, and many other investor groups for startups and growth companies. I hope you enjoy this episode. Thank you for joining us. Well, hello, this is Hall Martin with Investor Connect. Today we're here with David Arcara, a partner at Laconia Capital Group. David, thank you for joining us.
You're welcome, Hall.
Can you tell us how you got into venture capital?
I got in with, sort of serendipitously. I had been an entrepreneur for 20 years, a few startups, originally actually in the broadcasting industry, buying radio stations. And I built a small group, which I sold to Clear Channel, based out of San Antonio, so a little south of where you are. And then got into the digital side of things in the late 90s, starting with some friends, co-founding a company called UGO Networks, which eventually was sold to the Hearst Company. It was one of the first ad networks where we were aggregating web publishers online. It was a demographically targeted network for men 18 to 34 and was, in the Web 1.0 days. And then went on and started a branded content company, which eventually was consumed by Random House. We launched the company as Random House Custom Media. It was there for a year and a half, and then had an idea for, actually, I went briefly to another web publishing company, and then less than a year there, I had an idea for a video startup. This is now 2008, 2009. The world was kind of collapsing around us. My partner and I took our best shot at it, but couldn't get it off the ground. So out of the ashes of failure, I guess, I became a venture capitalist. So I didn't have another idea for a startup. This is now 2009. Had some good fortune with my own companies in the past and decided that moving to the capital side of the ecosystem would be a lot of fun and productive. So the first thing I did was to see if I could get deal flow and find a good working thesis. And part of that was joining New York Angels, which is the largest angel group up here in New York City. And that's where I met Jeff Silverman, who's now my founder, he's co-founder and partner. Jeff and I met because it was now 2010 at New York Angels and became fast friends, and then started doing not only angel investing together, but put together our own angel group called Laconia and started to craft what became the Laconia Capital Group thesis, and then institutionalized our activity starting back in 2014. So we are now Laconia Capital Group onto our second fund. And we also, a year ago, launched a asset management company called Laconia Venture Asset Management to manage the venture assets on behalf of family offices. We noticed in our travels that family offices really struggle with the venture asset class. It's an asset class that really demands a more active approach to investing, which is not something that family offices are set up to do. So we brought in a managing partner, a fellow named David Lee, to run that business for us. So we were excited about the future of Laconia.
So what does Laconia invest in? What do you guys look for in deals that you fund?
So we are exclusive to the four major Northeast markets, New York, Boston, Philly, and DC. We are exclusively business-to-business investors, and we focus on the late seed stage. So in our travels, we've noticed that there are effectively three kinds of companies that raise seed capital. There are those that raise seed and fail, which unfortunately the majority. There are those lucky ones, I guess you could say lucky, that raise seed and then are off to significant A-round institutional financings. That's not the market we serve. And of course, the outcome of those can also vary. But what we like and what we've learned over the last 8 years is there's a really good group of great companies that raise seed and effectively need an additional round of capital to maximize garnering that A round. And that's where we like to play, to help those companies that have product in market that are typically generating $25,000 to $75,000 in monthly recurring revenue, that are probably have raised, anywhere from maybe $750,000 to a couple $1 million. And they're looking for another 1.5 to maybe 4 on the outside, sweet spots 2 to 3 to further prove out scalability and product market fit. And that's where we really like to come in, plays to Jeff's strength and my strength as former operators. Jeff, too, did not come up through the finance industry. He is an entrepreneur and operator by trade. So we like to be very involved with our portfolio companies. That way we feel we add a tremendous amount of value. So that's the focus of Laconia.
So, what are the metrics you look for to see if you want to pursue a investment with them or not? Is it the usual cost of customer acquisition versus the lifetime value, or do you look at other key metrics there?
I mean, obviously, you want to keep an eye on cost of acquisition. You look at lifetime value. We like to see, a good steep sales trajectory. We're very, very revenue biased. We like to see variability on the expense side. So we have the optionality of hitting nominal break evens along the growth curve. We find that is very, very helpful. The MRR metric's important to us. By the time we conclude a deal, our companies are usually, in the $50,000 to $75,000 range of MRR. We'll start looking at them and maybe seriously talking to them around 25. Of course, we keep an eye on everybody that's raising seed capital in the Northeast and trying to find the best companies to track. We like to meet entrepreneurs early. Relationship is really important to us. We are sector neutral, so we tend to look for workflow processes that are being digitized from manual and legacy software systems. So that's a very big sweet spot for us. But again, the industry that it's in is a little less important as long as we can understand what that workflow is and what's going on. Hardcore tech investments, pioneering technology, healthcare device and disease, energy, ag tech, that stuff we pretty much stay away from, though.
So we've all heard of product market fit, and usually at that stage, they've got something of that going on. And then there's also channel fit and founder fit. How much of this do they have to have in place before they'll get interest from you guys?
Well, product market in the sense that we have to really believe that the solution is solving the problem that's being defined. And the good thing about our thesis is that it is looking for highly definable problems that are causing high pain points within a particular industry. So the inevitability of the transformation of the workflow to digital is inevitable, right? So the question is this the team, and is this product really nailing that problem? So we do in our diligence, we talk to a lot of customers or potential customers. So product market fit's pretty important. On the channel side, that's part of what the late seed capital is used for, is to continue to refine the sales funnel and the sales cycle and customer segmentation prioritization. So we work with them and use the capital to further get that sussed out because we feel that that's important for the A round. So that's sort of some of our thinking around that.
Well, to switch gears for a few moments, you talked about helping family offices raise funding, and I've seen a big shift, like you mentioned, family offices wanting to do deal flow direct and invest direct and so forth, but in many cases, they're really not ready to do that. What are the biggest challenges you see with family offices moving into the venture space and moving past VC funds and doing the deal flow directly themselves? What are they finding there?
Well, there are many, many family offices that want to be in venture. They read about venture, and even in some sense, the next generation of the family has an interest in it on a high level. Where they struggle is creating a disciplined approach, a structure around it, a thesis around it, a process, if you will, of sourcing deals, a process around true due diligence, particularly if the family wanders beyond their industrial expertise, if you will. So if it's a real estate family, they probably should stick to real estate investing if they're going to do directs. And if they're going to get into hardcore artificial intelligence investing, AI or blockchain, unless they have developed some expertise around that, they would be much better served finding funds that focus on those sectors. So when we're advising a family office, we actually advise them to put the majority of their venture dollars into funds and then reserve a minority of that for directs that cater to their own industry expertise.
And what do you find their sweet spot is for doing investments? Are they at the same place you are? Are they later stage or the earlier stage, or are they all over the map?
Yeah, they're all over the map. Part of what we discuss with them when we bring someone in is where do they want to play in venture? And we have, we're big believers, obviously, in venture. We believe that every large portfolio should have a percentage allocated to venture capital, that's an important alternative asset class. And then we discuss where their comfort level is, what their return expectations are, what their liquidity needs are. And that will determine a lot about what stage they should be in, how much capital they should allocate in any particular stage or industry sector, and again, the mix between funds and directs. So it's very bespoke.
Notice a lot of family offices really have a social impact or want to do impact investing. And how do you see that playing into it? Do you see them really wanting to do both venture funding as well as impact funding, and they're trying to put the two together? Or do you find them really two separate groups?
Yeah, I think it's two separate groups. We've not encountered a lot of that, at least with the family offices that we're dealing with. I know that there is interest out there for that, and we would certainly not try to dissuade somebody from that. But interesting, it's a good question. It has not come up, at least in the folks that we've been talking to, but maybe we'll discover more of that as we get deeper into it.
I find they want both, but it's hard for them to reconcile both. It's either I'm a nonprofit, I'm handing out grants, or I'm venture funding and we're getting an ROI. And marrying the two together can be a challenge, I think, for some, and it's not easy to do. But I was just curious what you were seeing in that direction.
I mean, a lot of the large family offices, of course, have foundations, and they're doing their philanthropy through that, and even some of their impact investing through that, which would be distinct from the bucket of capital that we would be managing.
And aside from deal flow and having a disciplined process, what are the other challenges you see family offices struggling with to get into this space?
Well, I mean, there's the due diligence process, the building of relationships with entrepreneurs, which takes an incredible amount of time. The managing the portfolio itself, to really be effective, and particularly at the early stage, and have influence. If you're going to just receive quarterly financials, you're going to limit yourself. You should have some view into the boardroom. You should hopefully have negotiated the right, if you're not an observer, to receive the board deck. You should have conversation on a reasonably frequent basis with the co-founding team. We're strong believers in active portfolio management. Again, particularly at the early stage when the entrepreneurs are looking for guidance and support, connections and entree. And all of these things are very hard for family offices to focus on because it's time consuming and costly, frankly.
So when a family office invests in a startup, how many hours do you recommend they spend on that startup with board reports and maintenance and coaching and all the other things that go with an investment into it? What kind of commitment do you think comes with an investment by a family office to then be successful?
I don't know if it's much different from being a VC. Obviously, as much time is required. I don't mean not to define that, but at the very early stages to a new investment, hopefully in some shape or fashion, after you close the deal, hopefully you're spending probably, it doesn't require a lot of time, an hour, 2 hours a week, but if you're doing that on top of diligence and deal sourcing, as well as all the administrative work to make sure your accounting is correct and back office is properly managed, it all adds up.
And how do you help them set up deal flow processes? It seems like that's one of the biggest challenges they have of finding quality deal flow. Now, you can always find deals. That's not hard, but those that fit your sector stage, usually takes a little bit of work itself.
Sure.
How do you help them with that?
Well, I think it's putting structure to it. If you think about a deal, sourcing deals in some sense is a sales process, in that you want to have your target mapped out. You want to identify who the players are in the sector that you're focusing at and segment within that. And then the networking that goes into reaching and meeting those folks and being involved in whatever activities are associated with that industry, be it conventions and conferences, universities that serve those industries. I mean, it's a lot of mapping to do it right, and it takes a structured approach. So that's what we try to work on, depending on the needs of the family office.
I found in the family office world, they have a lot of these day-long meetups or panels put together by law firms or whatever of people that are raising funding, people that are invested, and there's the different family office networks around the country that facilitate these group meetings and so forth. How effective do you think those are in teaching family offices or providing deal flow to them?
It's kind of like college. You get out of it what you put into it. They can be very effective if you do the follow-up work that's necessary. I think from actually managing a venture fund, I'm not sure you'll learn how to do that at those conferences, but from a deal flow, networking, co-investor point of view, they may be effective. You'll learn some of the basics, but you're not going to really learn how to manage a fund that way. I think that takes either somebody holding your hand or trial and error.
Sure. Well, in the last minute or two we have here, thank you for taking time to talk about Laconia and about family offices getting into the venture world. But what else should we talk about that we haven't covered so far that's on top of your mind?
See, what's on top of our mind is always finding great deals. Just in general, we're very, very bullish on the Northeast. I've been in this ecosystem, particularly in New York City, for almost 20 years, and the growth that we've seen has been just remarkable. And the professionalism that has developed, particularly here in New York, has been great. We're very, very bullish on New York City, and I think in the aggregate, the Northeast is highly competitive with Silicon Valley, yet we still have valuations that are much more reasonable. And I think that's a very long-term positive thing. I think New York in particular, we focus on business fundamentals in the way we invest here. And we try to keep valuations more strategically aligned, if you will, with the operating plan. So that's something that we're very focused on. So I think a good market, a lot of digital transformation still going on across many industries. And of course, once one transformation happens, there's always another one. So there seems to be perennial opportunity in the world of technology and software investing. So very excited about it.
Well, that's great. Well, how best for the audience to get back in touch with you?
It's actually pretty simple. I'm David at LaconiaCapitalGroup.com. You can go to our website, LaconiaCapitalGroup.com, and see everything that you need to know about us. So, as we said, we're pretty easy to get in touch with. And if you want to get a warm introduction to us, we know tons of people. So it's not too difficult, I wouldn't think, to find somebody who knows us and would be willing to put you in front of us in some way. So, we do prefer warm calls to cold calls. We tend to find that they're more effective, frankly, although we look at everything and we'll, that comes through the transom, invited or not. So.
Well, great. Well, thanks for taking time to share your thoughts with us today, and hope to have you back for a follow-up on some of these topics in the near future.
Great. Thanks, Hall. Really appreciate it.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.